The topic we are going to discuss today is asset allocation of retirement money. Our financial expert Mr. Hariharan is with us today to explain this to you with a real life example. Hari, over to you.
Now, Hitesh wants to do retirement planning, and I'm going to take you back to the year 2003. That is when he was 40 years old, and he again meets an advisor, Mr. Ramlingam, and he says that I want to plan for retirement. I will be due for retirement after 20 years. So he's going to retire in the end of 2022. And this Hitesh was a bit fortunate. He had a lot of money at that point in time itself. Ramlingam guided him to do a lump sum investment. But one good thing that Mr. Ramlingam did was he said, let's not put the entire 100% money in equities. Let's put a part of it into debt also, which is what we call as asset allocation, which is you distribute the investments across different asset classes. So 80% of the 20 lakhs is gone to equities and 20% of 20 lakhs is gone to debt. And this is how the money has grown over the last 20 years. So that 20 lakhs has become 3.6 crores, right? So what I'm trying to say is that for all your long-term goals, we normally do only SIPs. Can you also do a SIP in debt mutual so that you take care of the asset allocation? Why asset allocation is important? Because this is what equity does. This is the data from 1999 to 2022. Equity markets will be the best performing asset class, is no doubt. Even in the future, it's going to be the best. There's no doubt about it. But the fact is, you are going to face ups and downs in the equity markets, which again, all of us know. But the reality is, how do we face it, right? So if you look at this, we are okay with 68, 77, 45, 28 positive returns every year. We're very happy about it. But the moment it crashes, 50%, 20%, 24% is where the challenge comes. All of us, please remember, as human beings, are emotional in nature. And one of the emotions that hits us in a down market is fear. The fear that the market will correct more, it will fall more, my losses will increase, so let me exit. So those emotions always play in the mind of investors, and therefore asset allocation is one of the tools by which you take care of these fluctuations. How does it happen is that when you put only 100% all your money in equities, and if the market were to correct by 20%, your 100 becomes 80. And for that 80 to again become 100, you can't go with a 20% jump, you'll have to go with 25% jump. On the other hand, if out of 100 you have put 80 in equities, 20 in debt, debt is like Rahul Dravid. It will give you stable returns. You will not get those ECG graphs which you find in equities. So even if markets correct by 20%, your 80% is getting impacted by 20%. Your debt will give positive returns. So that positive returns will compensate for some of the losses in equities. So on a relative basis, instead of 100 becoming 80, you might end up with 100 becoming 90, which is always better. Now, why this is important, let's understand from a psychology perspective. Okay, answer me this question in the chat. I'm sure all of you also face electricity cuts, right? What is the first thing that we do when the electricity supply goes in our house? What is the first thing that we do when electricity goes? Even before candles, what do we do? Call the electricity board. What is that works inside our mind? We'll go outside and look what? Absolutely, we look at neighbors. Oh, namload it's okay, but we quickly check, is everybody also getting impacted or not? And the moment we realize, electricity has gone, we feel okay. I am not the only one who is going to suffer. Everybody is also going to suffer. And somebody will get that phone dialed to EB and that will get sorted. I don't have to worry. But if it's only my house, then I have to do all the running around, isn't it? So this is how psychology works. This is how mind works. And the same exactly happens in investments. So 100 becoming 80 versus 100 becoming 90. You're better off with 100 becoming 90, and that is what asset allocation does, right? So how much percentage has to be given to you, again, is individual specific, but these are the context, basically where you can apply debt mutual fund.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.